Silver closed today, Tuesday, April 28th, 2026, at $73 per ounce. And I need you to understand something right now. That price makes absolutely no sense, not because I think it should be higher, not because I'm bullish, but because when you line up every single fundamental data point, every institutional forecast, every supply metric, and every demand indicator, the number $73 does not fit anywhere on the spectrum of logical pricing. Bank of America's commodity research team has a bull case target of $309.9 for silver in 2026. JPMorgan's forecast is $81 as the annual average. A Reuters poll of 30 professional analysts published this week shows a median 2026 price target of $79.50. The current spot price is $73. That means silver is trading below the most conservative institutional forecast by $8, and it's trading $230 below the most aggressive bull case from a major Wall Street bank. Let me put that in perspective. Bank of America is not some fringe newsletter or YouTube channel making wild predictions for clicks. This is one of the largest financial institutions in the world, with a commodities research division that advises trillion-dollar funds. When they publish a $309 price target, that number went through multiple layers of analysts, risk committees, and compliance reviews. It's not a guess. It's a scenario model based on supply deficits, industrial demand, and monetary conditions. And the gap between their model and the current market price is 323%. That is the largest institutional forecast to actual price divergence in the recorded history of silver analysis. I went back and checked. In 2011, when silver hit $49, the highest institutional target at the time was around $65 from Credit Suisse. That was a 33% gap. In 2020, when silver was at $18 and about to run to $30, the highest target was $35 from Citi. That was a 94% gap. We are currently looking at a 323% gap between reality and the bull case. Nothing even close to this has ever happened before. So either Bank of America's entire commodities team has lost their minds, or the paper price at $73 is the most mispriced asset in the global market right now. Let me show you why I think it's the second one. Start with the supply side. The Silver Institute confirmed in their 2026 World Silver Survey that global silver mine production in 2025 was 830.5 million ounces. That's flat compared to 2024. It's actually down slightly from the 2022 peak of 843 million ounces. Despite silver's price running from $24 in early 2024 to over $120 in January 2026, mine supply has not increased. And there's a reason for that. 70% of the world's silver comes as a byproduct of copper, lead, and zinc mining. You don't increase silver production by opening silver mines. You increase it by opening copper mines, and copper mines take 7 to 10 years to develop. Here's the part nobody is talking about. China controls 60% to 70% of global silver refining capacity. In March 2026, China implemented export restrictions on sulfuric acid, which is a critical input for copper smelting. Sulfuric acid shortages directly reduce copper refining output, which directly reduces byproduct silver output. Nickel prices jumped to a 2-year high on Monday, April 27th, specifically because of sulfur shortages affecting Indonesian nickel production. FX Street reported this yesterday. The same sulfur supply chain disruption that is spiking nickel prices is quietly choking silver byproduct supply, and the market hasn't priced it in yet. So production is flat to declining. Now let's look at demand. Total silver demand in 2025 was 876 million ounces, according to the Silver Institute. Demand exceeded supply by 46 million ounces. That's the 6th consecutive year of supply deficits. If you add up the deficits from 2021 through 2025, the cumulative drain from global inventories is 762 million ounces. That is nearly 1 full year of global mine production that has been pulled out of warehouses, vaults, and stockpiles and consumed. Industrial fabrication accounts for roughly half of total silver demand. Solar panels alone consumed over 200 million ounces in 2025. Every solar panel requires silver paste for the photovoltaic cells. There's no substitute that matches silver's conductivity at scale. Finance magnates reported on April 26th that industrial fabrication demand for 2026 is forecast to decline 3% to a 4-year low due to the Iran war's impact on global economic growth. So the bears would say, see, industrial demand is falling, that's why silver is at $73. But here's what that analysis misses. The 3% decline in industrial demand still puts 2026 total industrial fabrication at approximately 485 million ounces. Mine production is 830 million ounces. So even with declining industrial demand, You still have a 46 million ounce deficit when you add in investment demand, jewelry, and silverware. The deficit doesn't go away just because industrial demand softened slightly. And here's the kicker. AI infrastructure demand is ramping at the exact same time traditional industrial demand is softening. Microsoft, Google, Meta, and Amazon are collectively spending $670 billion on AI data centers and cloud infrastructure in 2026. Every server, every cooling system, every power distribution unit, and every networking switch uses silver. Not a lot per unit, but when you're deploying billions of dollars of equipment, it adds up fast. The estimate I've seen from semiconductor supply chain analysts is approximately 0.5 to 1 gram of silver per $1,000 of AI infrastructure spend. At $670 billion in capex, that's 335,000 to 670,000 kilograms of silver demand, which converts to roughly 10 to 21 million ounces. That is incremental demand that did not exist 3 years ago, and it's growing at 40% per year. None of the legacy silver deficit models include this because AI infrastructure spending at this scale is a 2024-2026 phenomenon. So you have flat mine supply, a structural deficit that's been running for 6 years, and a new demand source from AI that's adding millions of ounces per year. And the price is $73. Let's keep going. COMEX registered silver inventory as of Monday, April 27th, is 76.88 million ounces. In January 2020, registered inventory was 240 million ounces. That's a 64% decline in 6 years. The total open interest in COMEX silver futures right now is 575 million ounces. That means the coverage ratio, the amount of physical silver backing the paper contracts, is 13.4%. For every dollar of paper silver being traded, there's 13 cents of actual metal in the vault. Here's why that matters. May is a delivery month for COMEX silver. First notice day was yesterday, Monday, April 27th. As of yesterday's data, 47,034 contracts are standing for delivery. Each contract represents 5,000 ounces. That's 235 million ounces of silver that traders are demanding physical delivery on. The registered inventory available to deliver is 76.88 million ounces. That's a 3-to-1 imbalance. There are 3 times more ounces being demanded than there are ounces available to deliver. Now, most of those contracts will get rolled forward or cash settled before final delivery. That's how the COMEX system works. But even if only 10% of those contracts demand actual physical metal, that's 23.5 million ounces against a registered inventory of 76.88 million. That would drain 30% of the available COMEX silver in a single delivery cycle. And we're already at the 6th consecutive month of delivery stress, according to FX Street's April 27th analysis. If the COMEX registered inventory drops below 50 million ounces at any point in the next 3 months, you're in squeeze territory. Traders start to question whether the exchange can deliver on all the contracts. That's when you get short covering, which is when traders who sold silver they didn't own have to buy it back at any price to close their positions. A short squeeze in silver with this level of paper leverage could move the price $20 in a single session. We saw it happen in January when silver went from $71 to $120 in 3 weeks. Now, let me show you the physical market in Asia, because this is where the pricing disconnect becomes undeniable. The Shanghai Gold Exchange is the primary physical trading hub for silver in China. As of this morning, Shanghai silver is trading at approximately $88 to $90 per ounce. The COMEX spot price is $73. That's a $15 to $17 premium. That's 20% to 23% higher than New York pricing. Why would Chinese buyers pay $90 for silver when Americans can buy it at $73? Because they can't buy it at $73. The $73 price is a paper price on a futures exchange. If you want actual physical silver delivered to Shanghai, you're paying $90, and Chinese buyers are paying it. Finance magnates reported on April 26th that China's silver imports in January and February 2026 totaled 206.76 metric tons. That is the highest 2-month import total in 8 years. So let me make sure you understand what's happening. The country that controls 60% to 70% of global refining capacity is importing silver at an 8-year record pace and paying a 20% premium over the Western paper price to get it. That is not the behavior of a market that thinks silver is going lower. That is the behavior of a market that knows physical metal is scarce and is willing to pay up to secure it before the scarcity gets worse. And it's not just China. India's rupee collapsed to an all-time low of 91.7 against the dollar yesterday. When a currency collapses in India, citizens don't buy stocks or bonds. They buy gold and silver. The cultural response to currency devaluation in India is immediate conversion to precious metals. The rupee fell 1.4% last week alone. which caused domestic silver prices on the multi-commodity exchange in India to drop Rs 12,506 per kilogram in a single week. That's a 4.9% drop, but that drop was entirely due to the rupee's collapse, not because Indian demand for silver declined. In fact, when you adjust for currency, Indian buyers are paying more in rupee terms to get the same ounce of silver. So you have China importing at record levels and paying premiums. You have India converting currency devaluation into precious metals. You have the COMEX registered inventory draining for 6 consecutive months. You have 6 consecutive years of supply deficits. And the price is $73. Let me show you what the U.S. defense stockpile situation adds to this. A Fortune reported on April 27th that the U.S. military has depleted approximately 50% of its most expensive precision-guided missiles during the Iran war. Tomahawk cruise missiles, JASSM extended-range air-to-surface missiles, and GBU-57 bunker busters all use silver in their guidance computers, radar systems, and circuit boards. Rebuilding half of the U.S. missile stockpile is going to require emergency defense procurement over the next 4 years. The Pentagon hasn't even submitted the supplemental budget request for this yet, because the full extent of the depletion only became clear in the last 30 days. When that budget request comes, and defense contractors start ordering components, they're pulling silver from the same global supply chain that's already running deficits. That is a structural demand source that appeared in 2026 and will continue through 2030. It's not in any analyst model because it's a direct result of the war. Here's the institutional forecast summary, and I want you to see how extreme the divergence is. JPMorgan, $81 average for 2026. That's the most conservative major bank forecast. Current price, $73. Gap, $8 below. Reuters poll of 30 analysts, $79.50 median for 2026. Current price, $73. Gap, $6.50 below. Goldman Sachs has a gold range of $4,000 to $6,300, which implies a proportional silver range of roughly $70 to $110 based on historical ratios. Current price is at the bottom of that range. Bank of America, $135 to $300 bull case. Current price, $73. Gap, $62 to $236 below. Silver is currently priced below every single institutional model. Not some of them, all of them. When was the last time that happened with any commodity? I can't find a precedent. Even in March 2020, when oil went negative, there were analysts who had modeled a temporary collapse scenario. Right now, there is not a single major bank or institutional analyst who thinks $73 is the correct price for silver in 2026. And yet, that's where it's trading. So what explains it? The answer is the dollar. The US dollar index has been strengthening since mid-April. When Iran peace talks collapsed for the third time on Monday, the dollar spiked. Silver is priced in dollars. When the dollar strengthens, silver's price in dollar terms falls, even if the value of silver in real terms hasn't changed. This is a currency effect, not a supply-demand effect. But here's the problem with that explanation. The dollar is strengthening because the market believes the Federal Reserve is going to keep rates higher for longer. And the Fed is keeping rates higher because inflation is still running at 3.3% on CPI, and consumer expectations are at 4.8%. So the dollar is strong because inflation is high. But silver is supposed to be an inflation hedge. If inflation is high, silver should be rising, not falling. The dollar strength narrative only works if you believe inflation is going to come down, but the data says inflation is not coming down. The University of Michigan Consumer Sentiment Survey released its final April reading last week. The headline sentiment number was 47.6. That is the lowest consumer confidence reading ever recorded in the history of the survey. The survey started in the 1940s. We just hit an all-time low. The one-year inflation expectation in that same survey, 4.8%. Consumers have never been more pessimistic about the economy, and they've rarely expected higher inflation. The Conference Board releases its consumer confidence report this morning at 10 a.m. Eastern. March's reading showed inflation expectations rising sharply. If today's April number shows further deterioration in the jobs outlook component, that's another confirmation that consumers see the labor market weakening while prices keep rising. That's stagflation from the ground up. And speaking of stagflation, let me give you the GDP setup for Thursday because this is the binary event that decides silver's direction for the next month. The advance estimate for Q1 2026 GDP releases Thursday morning, April 30th at 8:30 a.m. Eastern. The consensus economist forecast is 2.2% growth. But here's the precedent that everyone needs to understand. Q4 2025 GDP was initially reported at 1.4% growth in the advance estimate. The final revised number that came out 2 weeks ago, 0.5%. That is a 64% downward revision. If the Q1 advance comes in at 2.2% and follows the same revision pattern, The final Q1 number could end up near 0.8% by the time the third estimate is published in June. If the advance itself misses and comes in at 1.5% or lower, you're looking at a final revised number near zero or negative. 2 consecutive quarters of near zero growth with 3.3% inflation is the textbook definition of stagflation. And here's what happened to silver during the last major stagflation cycle in the United States. From January 1979 to January 1980, silver went from $6 per ounce to $49 per ounce. That's a 17% gain in 12 months. The conditions that caused that move: high inflation, low growth, and a Federal Reserve that was trapped between fighting inflation and avoiding a recession. We are in the exact same macro setup right now. CPI is 3.3%. GDP is potentially heading below 1%. The Fed funds rate is 3.5% to 3.75%. The Fed can't cut because inflation is too high, and they can't hike because growth is too weak. They're stuck. The CME FedWatch tool updated yesterday shows that the market has now pushed out rate cut expectations to mid-2027. 3 weeks ago, the market was pricing one possible cut by the end of 2026. That cut has now been completely removed from the probability curve and pushed 15 months into the future. FX Street reported this as the largest single shift in rate expectations for the entire year. The market went from maybe one cut to no cuts for over a year in less than a month. If the market is right and the Fed holds rates at 3.5% to 3.75% through mid-2027 while inflation stays near 3%, real interest rates stay near zero. A zero real rate environment is neutral for silver in theory, but in practice it's bullish because it removes the opportunity cost of holding a non-yielding asset. If you're earning 3.5% on cash but inflation is eating 3.3% of that, your real return is 0.2%. At that level, there's no incentive to hold dollars over silver. Let me give you the technical picture because this matters for anyone trying to time an entry. Silver is currently at $73. The critical support level that has been tested 3 times in 2026 is $70. February 14th, March 9th, and March 28th, silver tested $70 and bounced every time. The lowest intraday print was $69.08 on March 9th, and it recovered within 4 hours. Physical buyers stepped in at $70 each time and created a floor. We are now $3 above that floor. If Powell's press conference tomorrow is more hawkish than expected, or if Thursday's GDP number is stronger than expected, and the market interprets it as the economy is fine, the Fed doesn't need to cut, silver could test $70 for a 4th time. If $70 breaks, the next technical support level, according to Finance Magnate's analysis, is the 200-day exponential moving average at $65. That's an $8 drop from current levels. But if $70 holds for a 4th time, that's a quadruple bottom, which is one of the strongest reversal patterns in technical analysis. A quadruple bottom that holds during a period of deteriorating economic data and persistent inflation is a setup for a violent move higher. The risk reward at $73 with a $70 floor and an $85 to $90 upside target is asymmetric in favor of the bulls. Here's my conclusion. Silver at $73 is either the buying opportunity of the year or it's a warning that something fundamentally broken is about to get worse. I don't think it's the second one. The supply deficit is real. The COMEX inventory drain is real. The Shanghai premium is real. The Chinese import surge is real. The defense stockpile depletion is real. The AI infrastructure demand is real. Every single fundamental data point says silver should be higher. The only thing keeping it at $73 is dollar strength driven by the belief that the Fed will keep rates high. But the Fed keeping rates high while growth slows is the exact condition that creates stagflation. And stagflation is the historical catalyst for silver's biggest moves. We're 1 week GDP print away from the entire narrative flipping. Thursday morning at 8:30 a.m. Eastern, we'll know. That's the Tuesday, April 28th, 2026 reality check. Silver is at $73. The data says it should be at $79 to $309, depending on which model you trust. Something has to give.